Well, rates are below 7%. We got to talk about why I am afraid for the housing market. Let's talk about the week ahead. Let's give you a picture of what we will be listening to from various Fed presidents. We will also talk about key earnings next week. And of course, I will remind you of the 3 steps to get wealthy. Folks, I'm recording this early. Excuse me. I'm recording this on Thursday as I have some family plans Sunday morning. So I will not be able to do the Sunday daily financial news live, but it's important for me to get you this video. So let's start with the week ahead on the economic front. Monday, we will get new home sales. We will also start to hear from Fed presidents. There will be at least 3 speaking. On Tuesday, we will get Case Shiller. Will once again show that home prices are rising. We'll also get consumer confidence. Wednesday, some more Fed speeches. Thursday, initial home claims, pending home sales, and consumer sentiment. The big number for the week will be PCE, personal consumption expenditure, the third and final inflation reading for the month of February. It is expected to come in hot. Once again, we will see inflation tick up, much like it did in CPI. Remember, CPI headline, I think, went from 3 to 3.1 or maybe 3.1 to 3.2, something like that. They are expecting that headline will go up from 2.4% to 2.5. Once again, breaking trend. Equally concerning is the month-on-month number is expected to come in at 0.4, which when you analyze it by timesing 12 is a pretty ugly number. PCE core last was 2.8, again expected 2.8. So again, inflation proving to be sticky with a month-on-month reading of 0.3. So again, important housing data. We get some home prices. We get pending home sales, new home sales. It will be very interesting. And again, as I mentioned, I think it was Thursday morning, I had a feeling that rates would go below 7%, and they are. One of the measures I saw that said rates below 6.9. So why do I think that's concerning? Why are rates below 7% bad? Right? Isn't that great? Right? First and foremost, for the haters out there that don't understand, I am hoping for a normal housing market sooner rather than later. I believe seeing rates go below 7% does not help get to a normal market. I don't know what to tell you. A normal housing market is years off. If you don't believe me, do yourself a favor, go to onerentalatatime.com and download the free 54-year spreadsheet that has been updated with 2023 information. Shout out John Sterling for that help. That spreadsheet shows you the last time interest rates went up fast, transactions crashed fast, that it took over a decade to return. I believe seeing rates tick under 7% does not help us get there. In fact, it slows us down. So I see kind of these steps or dominoes. One, as we've been reporting weekly, Alto's Research, Housing Wire, Resi Club, inventory or listings is building. Not fast, but still building. Each week for the last 3 or 4 weeks, we have been adding net new active listings. That is good. That is not bad. That is good. Number 2, we have a bifurcated housing market. I have been telling you for well over a year, and maybe even 2 years now, that you should look at your market in one of 2 lenses. One, figure out the median home price, and then look at the listings below and above. What most people are telling me, and I am seeing myself, is above the median, aka luxury, is slowing down, where below the median, first time or entry level is on fire. If that is true in your market, and we see rates below 7, we are going to have consumers, or what is called marginal demand, return. In fact, we now have evidence of this. Look at what happened in your housing market in January. Lots of activity, lots of offers. We were hearing from agents on this channel with 20 plus offers repeatedly, not a one-off. We had some offers of 40 and 50 offers. That is not good. That is not a healthy housing market. What that means is when we saw that activity in January, the last time rates were below 7, it produced a home sales report in February that was up 10%, 9.8%. We have evidence. We know what consumers will do. I've been studying the consumers for 30 plus years as an economist, and it is rather predictable. Marginal demand, in my opinion, is going to be unlocked. Rates, it is this simple. Rates below 7, good. Rates above 7, bad. That is why I want rates above 7, so we can slow down and take a breath. Now, rates are below 7. Rates are below 6, 9. Rates could be heading lower. What is my biggest concern? My biggest concern is folks at the entry level trying to buy their first home, who have likely been trying to buy homes for a year or two, get frustrated. And I don't mean get frustrated and leave. I mean get frustrated and write a stupid offer. If you start writing stupid offers just to get a home, you're going to do something stupid, and probably several something stupid. You're going to overpay, and you are going to select something you won't be happy with because it is available. That behavior, if done in mass, leads to a housing bubble, an unhealthy housing bubble that could cause gigantic pain in years to come. I am hoping for a normal housing market. Again, I believe rates above 7 allows inventory to build. Rates below 7, not so much. And then we're here. So let's find out. Let's see in 2 or 3 weeks, maybe 3 weeks, if the marginal demand has come back and we are starting to absorb those listings. That is my greatest fear. So again, folks, the PCE reading on Friday is important. Again, they are looking for a hot reading. This will be our 6th inflation number that is hot, which is not good. That month-on-month number of 0.4 for PCE headline is concerning. Inflation is sticky and ramping, at least it appears to be. I went back and thought about what the Fed said on Wednesday. So let me see if you see it the same way. 1, GDP is expected to be stronger, aka the economy doing better. 2, inflation is expected to be sticky or hotter. And number 3, the job market is expected to be stronger. So let me get this right. GDP better, inflation worse, job market stronger. And, oh, by the way, we're going to cut 3 times. It still does not feel right to me. Again, I was hoping for somebody to threaten to raise rates. Not that they will. I have no belief they would. I just wanted the threat. Now, I've been thinking about this for 48 hours. And the thing that I think is lurking behind the scenes is a banking crisis. Remember Silicon Valley Bank? 10-year notes, blew up their balance sheet, had to raise debt, bingo, bango, gone. We then saw New York Bank Corp more recently have to take on a $1.1 billion bailout, essentially. My guess, and it's just purely a guess, purely speculation, is they're looking at the commercial banking system and going, you know what? We can't go higher. If we go any higher, the slow bleed that we have now in the commercial housing market is going to explode. I think right now they feel like they got a Band-Aid or tourniquet on the commercial market. Yes, there'll be some pain. Yes, there'll be losses. Yes, the equity is gone, but the debt is actually okay. My fear is if they go higher, it makes extend and pretend not work. And I think that might be what they are going for. How about Mohamed Al-Arian? He came out yesterday today with a interesting take on interest rates. He thinks that the Fed should wait years to cut rates. Talk about higher for longer. If you've been on the channel for any length of time, you know that the end of last year, I was putting out something to some of my guests that I thought the Fed could be on hold all year and was routinely laughed at. If the Fed goes on hold all year, it will be an 18-month duration from their last raise and their pause. The current longest, I think, is 15 months. Might be 14 months. But again, Mohamed Al-Arian is talking years. So we're talking 30, 36 months before the Fed could cut rates. Talk about higher for longer. A couple of earnings next week I think will be interesting. GameStop. Do you ever watch the movie Dumb Money? It was It was entertaining. Dumb Money. Gotta tell you, Robin Hood did not look good in that movie. Woof. Robin Hood. Robin Hood was portrayed pretty negatively, in my opinion. Wednesday, we get Carnival, Rumble, and Paycheck. Carnival will be interesting. What is going on with the cruising crowd, the travel crowd? Are they still booking? Are they pulling back? Remember, we just heard from a European brand over Gucci. We heard from Lululemon and others that their earnings are weak. So it'll be interesting to see what's happening in the travel industry. And then again, folks, just to wrap us up here, if you want to get wealthy, you got to increase your discretionary income. Do you know what your discretionary income is each month? If not, you owe yourself to figure it out. Then you need to figure out how to grow it, cut expenses, increase income. Number two, you need to become elite at something. If you want to become an elite at buy and hold investors, there is no better value than the How to Get Started One Rental at a Time course. It is still only $399. And if you buy it today, I will throw in the $200 Vegas event. If you do buy it, don't forget to join the Facebook group that is private just for the students. Introduce yourself, communicate, become part of the group. And of course, do the work. Get a buy box, track, daily discipline, all of that. And then lastly, you've got to do it for 10 years. Getting wealthy takes time. Owning assets takes time. Inflation takes time. And again, never forget that the first 5 years suck. It's slow. It's painful. You will make mistakes, lessons learned. Again, folks, I'm recording this on Thursday for you, so you have it Sunday morning. Do me a favor, give me a thumbs up, a comment, like, subscribe. It is important to keep the run going. I will again be doing some family stuff Sunday morning, so I will be on the road, but I'll have my phone. So if you comment, I will say hello from the road. Take care. Thanks. Bye.